Okay. STTR, the second part, we have done the just structure. Structure of STTR. Now, STTR as well as the document. See, the document is divided into two chapters. The document is divided into two chapters, chapter number 1 and chapter number 2. Chapter number 1, chapter number 2. Chapter number 1 consists of the STTR rule. It consists of STTR rule, the provision, the rule, the provisions, and then an elaborate commentary. This STTR rule or the provision, this is like all those articles of the OECD Model Tax Convention that we have. Article 1, 2, 3, 4, all those 32 articles. It's created in the form of an article. It's an article because ultimately, see, this STTR will be, it's a treaty based rule, and it is expected that this will be incorporated into the existing bilateral tax treaties. So that is why it has been created in the form of an article. So this is an article, STTR provision, it's an article, right? So this is the article, and this article is divided into paragraphs. Paragraphs. There are 15 paragraphs. 15 paragraphs. These paragraphs are further, most of these paragraphs are further subdivided into subparagraphs. And some of these subparagraphs are further subdivided into subdivisions. Right? So you have STTR is an article. The article consists of 15 paragraphs. Most of these paragraphs are divided into subparagraphs, and some of these subparagraphs are further subdivided into subdivisions. Fine. And then you have an elaborate commentary on these provisions of the STTR. This is in chapter number 1. Right? Chapter number 2 deals with double taxation relief. DT relief. Because when STTR will be incorporated into the tax treaties, state will tax, and double taxation, in order to relieve the double taxation, there would be certain provisions which would be required. So chapter number 2 takes care of the double taxation relief under STTR. Right? Now what I am going to do, you know what, it's a fairly long provision, it's a fairly long article, and whenever STTR would be made a part of the double taxation treaties, bilateral tax treaties, it would be one of the longest articles, mind you. It would be one of the longest articles in the tax treaties. Fine, so it's a fairly long article. It's a fairly long article, 8-9 pages in the document, just to the article. Commentary is separate, right? So one of the longest articles it would become. So what I am going to do, I am going to simply take you quickly through these 15 paragraphs. Their headings, and the headings will give you what exactly is contained in those paragraphs, right? Okay. Okay. So chapter number 1, provision, STTR, 15 paragraphs, one by one. Okay, so we'll do one thing. Now we have R, resident state, S, source state. There is a tax treaty existing between them, R and S, right? Okay, so paragraph 1. Paragraph 1, the heading is taxing right in the estate, taxing right given to estates, where the covered income is taxed below the minimum rate. Taxing rights to estates where the income, covered income, don't worry, where the covered income is taxed, where in our state, at a rate where income is taxed at a rate below the minimum rate, that is minimum rate, how much? 9%. Two conditions have to be satisfied. That under the existing tax treaty between R and S, and there are specific articles which are mentioned under Article 7 business profits, Article 11 interest, Article 12 royalty, 21 other income. That is, in the tax treaty existing between R and S, if under any of these articles a state's taxing rights are limited. Number one, first condition. Second condition, and the income is taxed in our state at a rate which is less than the minimum rate of 9%. If these two conditions are satisfied, then a state is given the right to tax. Fine. Paragraph number 1. Paragraph number 2. A state is given the right to tax under paragraph number 1. But is this taxing right unlimited? No. This taxing right given to a state is limited to the specified rate. What is the specified rate? I'll tell you. What is the specified rate? Taxing right given to a state under paragraph number 1 is limited to specified rate. Specified rate is the difference. Between the STTR minimum rate, that is 9%, minus the tax rate. What is the tax rate? Tax rate is given under paragraph number 5. And this tax rate is nothing but the statutory tax rate which is applicable on this item of income, interest or royalty or whatever income it is. Statutory tax rate applicable on this item of income in our country. Right? So, taxing right given to us is limited to this rate, 9% minus the tax rate. That is the statutory tax rate. Fine. Paragraph number 3. Interaction with other treaty provisions. Interaction with other treaty provisions. This treaty. Interaction with other treaty provisions. If a state is able to, if a state may tax this specific item of income under the existing tax treaty between R and S, if S may tax this item of income under the tax treaty, under the RS tax treaty at a rate which is greater than or equal to the specified rate. That is, a state is already able to tax this item of income under some other provision of the tax treaty at a rate which is greater than or equal to the specified rate. If this is possible, then paragraph 1 and paragraph 2 will not come into operation. That is, STTR will not give any other taxing right to a state. This is paragraph number 3. Interaction with other treaty provisions. Right? 4. Covered income. We've talked about income, covered income. On what is the scope of STTR? What income is covered under the scope of STTR? Covered income. Interest, Article 11. Royalty, Article 12. Financial guarantee fees. Payment for the distribution or provision of services, insurance, reinsurance payments, and payment for the provision of services. These are the payments, covered income. These are the payments which are included. These are the payments which are included, which are within the scope of STTR. One specific rule, that is paragraph 4, paragraph 4.3. Paragraph 4.3. 4C, sorry. Paragraph 4C. Paragraph 4C. 4C is the source rule. It says that how do you, source rule. This deals with the fact, how do you deduce, how do you conclude that the income arises from S country. So it says that whenever the payer of the income, payer of interest, payer of royalty, payer of other payments, whenever the payer of the income is a resident in estate, then we'll say that this income arises in estate. Source rule, right? 5, covered income. Fifth is tax rate. Fifth, I've already told you. Paragraph 5, this tax rate. Fifth is the tax rate. It's a long provision. Fifth is tax rate. Tax rate. What is the tax rate? I told you the tax rate that is used for the calculation of the specified rate in paragraph number 2. This tax rate is a statutory tax rate that is applicable on this item of income in our country. And this tax rate takes into account any preferential adjustment. Preferential adjustment. This is defined in paragraph number 6. What is preferential adjustment? Preferential adjustment takes care of exemption, full exemption, part exemption. It takes care of deductions. It takes care of tax credits. Preferential adjustment, right? 6th. 7th, paragraph 7. Paragraph 7. Paragraph 7. Paragraph 7. Attribution of income. Attribution of income to PE's permanent establishments in third jurisdictions. In third jurisdictions. That is something of this sort. Okay, you have S, you have R. The payment is like this. You have a payment. You have ESCO. ESCO is a company. ARCO is another company. ARCO is the tax resident here. ESCO is a resident here. Supposing this is the royalty payment. Fine. Okay, just a second. Okay, you have ARCO here. And this ARCO has a PE. This has a PE. Fine. And this royalty income is attributed to this PE. This case is dealt under under paragraph number 7. Attribution of income to PE in third jurisdiction, S, R and T. Right? 7. 8. 8 is exclusions. Exclusions. Covered income, interest, royalty, etc. If supposing this income is paid by an individual. If this income is paid by an individual to another individual, income paid by individual to another individual, then this will be excluded. This is not within the scope of STTR, right? Or for that matter, this income is paid by ESCO and this income is received by ARCO, and ARCO and ESCO, they are not connected persons. They are not group entities. They do not belong to the same M&E group. They are not connected. If they are not connected, then also STTR will not be applicable. So this is very, very important. STTR is applicable to certain outbound intra-group payments. Payment have to be between connected persons. Fine. Exclusions. So individual, receiver is not the connected person. Then you have non-profits, government entities, then you have international organizations and so on. There are a number of instances, international organizations. Exclusions, right? 9 you have very important markup thresholds. Markup thresholds. Markup thresholds. Markup thresholds. Markup thresholds. See, 9 is mark up thresholds. So meaning to say, you have R, you have S. This is the covered income. ARCO is the receiver. If ARCO is receiving this covered income, if ARCO has spent certain if ARCO has incurred certain costs in earning this income, cost in earning this income plus 8.5% markup on cost. If this covered income is less than or equal to this, if this covered income is less than the cost plus 8.5% markup on the cost, then paragraph 1 and paragraph 2, that is taxing right given to estate, STTR will not be applicable. So meaning to say that if STTR has to come into picture, if estate has to gain a taxing right, then the markup, then this covered income has to be more than 1.085 times the cost. Right? If this covered income is less than 1.085 times the cost, then no taxing rights. Right? It has to be more than this. So 1.085 is the threshold. India has objected to this. Threshold, markup threshold, that this 8.5% markup is quite high, and it is justified. It is truly very high. Markup on thresholds. 10 you have connected persons. Connected persons, simple. Connected persons, two types of connections are given. Connected persons, STTI is applicable to intra-group payments between connected persons. Two types of connections are given, either parent sub, RS, or parent sub, control, parent sub, or second type of connection is given, that ARCO, ESCO, this is R, this is S, they are under the control of third entity, TCO. Fine. In either of these situations, this is parent sub and this is control. In these situations, parent and sub, they become connected persons, ARCO, ESCO become connected persons. Fine. 11. Connected persons targeted anti-avoidance rule. And remember, I told you that these sort of payments can be used by multinational groups for creating contrived contrived group structures, contrived schemes, contrived group structures that lead to BEPS in S countries. So targeted anti-avoidance rule under 11, targeted anti-avoidance rule is expected, is created to take care of any BEPS risk that might arise. Okay, two types of situations are covered here. Like this, you have RS, ESCO, intermediary, and ARCO. This is the original payment, and this is the related payment. Two situations are conceived, that ESCO makes a original payment to the intermediary, and intermediary within 365 days makes substantially the same payment to ARCO. So this is the related payment. So in this situation, if certain conditions are satisfied, then this roundabout can be disregarded, and this original payment can be thought of as being made not to this intermediary but directly to the ARCO. So this can be disregarded. This intermediary can be in R, this intermediary can even be in S. Very interesting. The document contains certain examples which demonstrate the application of this anti-avoidance rule. These examples are given towards the end of the document. 11. 12. Materiality thresholds. R and S, S developing, R developed. STTR will come into picture only when the smaller of the economies, S developing economy. There are two categories. If the size of S, the GDP of S is more than 40 billion euros, more than 40 billion S GDP S more than 40 billion euros. So in that case, the total size of these covered, these payments has to be more than 1 million euros. Only then STTR will come into picture. Below this 1 million euro, if the size of GDP is more than 40 billion and if the size of the covered payments are less than 1 million, then STTR will not come into picture. For still smaller economies, I mean for those economies whose GDP is less than 40 billion euros, the size of the covered income, the size of the covered payment is 0.25 million euros. Materiality thresholds. 12. 13 is application of STTR to PE in estates. PE in estates. And those of you who have read OECD Model Tax Convention, Article 10, Article 11, Article 12, you would remember this sort of RS, payment being made, ARCO receiving, and this payment is attributed to the PE that ARCO has in S. Similar sort of, fine. PE in estate. 13. 14 is administration. Administration, it says that STTR will be calculated on the total income at the end of the fiscal year, and unless the income has been determined at the end of the fiscal year, STTR will not, estate will not apply the taxing right under STTR. 14 administration. 15, implication. It simply says that STTR has been created by BEPS inclusive framework for addressing the tax challenges arising out of digitalization. It does not reflect the tax policies of either of the countries, and so on. Fine. So a very long article, 15 paragraphs, and this was just the heading. Fine. And then there are elaborate commentary provisions. How would the countries, RNS countries, how would they incorporate? It is said in the document, OECD says that a multilateral instrument is expected to swiftly enable the RS countries, all those RS countries who have tax treaties between them. Multilateral instrument would enable the swift implementation, swift incorporation of STTR into the RS tax treaties. Fine. Although it's only MLI is mentioned, but it can also be done, this incorporation of STTR can also be done on a bilateral basis. Fine. So I expect that STTR would become a part of the Model Tax Convention, and then Model Tax Convention will become a little thicker, some additional elaborate commentary provisions, and then there are, when you read the commentary, then there are interaction with other treaty provisions, interaction with, because you have an anti-avoidance tool, it would interact with Article 29 of the Model Tax Convention, and so on and so forth. Fine. So that's it for today. I hope you enjoyed and you did gain insights out of this video on STTR, subject to tax rule, latest sort of an update. And do subscribe to the channel International Tax Academy by Manoj Naudiyal, wherein I keep on posting videos relating to international tax, transfer pricing, tax treaties, and other updates. And keep learning. International tax is one of the most fantastic areas that you can ever encounter. Fine. And until next time, signing off. Manoj Naudiyal signing off. Thank you so much. Namaskar.